Hi all, I am Kapila Chourey from IIM Trichy and we are going to discuss about the issues related to non-performing assets in India. An asset becomes non-performing when it ceases to generate income for the bank. Earlier, assets were declared as NPA after completion of the period of the payment of total amount of loan and 30 days grace. At present, assets are declared as NPA if none of the installment is paid till 180 days with respect of term loan. There are three categories of NPA: substandard assets, doubtful assets, and loss assets. The main reasons for the rise in NPA are GDP slowdown. Between early 2000s and 2008, Indian economy were in the boom phase. During this period, banks lent extensively to corporate. However, the profits of the most of the corporate dwindled due to slowdown in the global economy. This has affected their ability to pay back loans and is the most important reason behind increase in NPA. Banks relax lending norms for corporates without analyzing their financial status and credit ratings. Public sector banks provide around 80% of the credit to industries, and it is this part of the credit distribution that forms a great chunk of NPA. Priority sector lending and increase in gross advances of scheduled commercial banks. Banks did not conduct adequate contingency planning, especially for mitigating project risk. Asset quality review, initiated in 2015 for clean and fully provisioned bank balance sheets, revealed high incidence of NPAs. Restructuring of loan facility was extended to companies that were facing larger problems of over leverage and inadequate profitability. Companies with dwindling debt repayment capacity were raising more and more debt from the system. Some of the steps taken by RBI and government in the last few years to curb NPA are the launch of Mission Indradhanush to make the working of public sector bank more transparent and professional in order to curb the menace of NPA in future. The Insolvency and Bankruptcy Code 2016 followed a creditor in saddle approach. This, coupled with debarment of willful defaulters and persons associated with NPA accounts from the resolution process, has affected a fundamental change in the creditor or debtor relationship. Amendment of the Banking Regulation Act 1949 provides authorization to RBI to issue directions to banks to initiate the insolvency resolution process under IBC. The SARFAESI Act 2002 has been amended to make it more effective with provision for 3 months imprisonment in case the borrower does not provide asset details and for the lender to get possession of mortgage property within 30 days. 6 new debt recovery tribunals have been established to expedite recovery. Under the public sector banks reform agenda, PSBs have created stressed asset management verticals for stringent recovery, segregated pre- and post-sanction follow-up roles for clean and effective monitoring, initiated creation of online one-time settlement platforms, committed to monitoring large value accounts by tying up with specialized monitoring agencies for loans of Rs 250 crores and above. The EASE Index. This index provides all public sector banks a comparative evaluation showing where banks stands. The index follows a fully transparent scoring methodology, which enables banks to identify precisely their strengths as well as the areas for their improvement. RBI introduced number of measures in last few years which include tightening the corporate debt restructuring mechanism, setting up a joint lenders forum, prodding banks to disclose the real picture of bad loans, asking them to increase provisioning for stressed assets, introducing a 5:25 scheme where loans are to be mortgaged over 25 years with refinancing option after every 5 years, and empowering them to take majority control in defaulting companies under the strategic debt restructuring scheme. These steps resulted in decrease of NPAs by around 3 lakh crores due to recoveries during the last 4 financial years. Now let's see how to curb the menace of public sector banks. Short-term measures. Review of NPA's advances. We need to assess the viability case by case. Viable accounts need to be given more finance for a turnaround, and unviable accounts should either be given to asset reconstruction company or management restructuring or permitting banks to take over the units. Government should establish asset reconstruction company with equity contribution from the government and the Reserve Bank of India. The established ARC should take the tumor out of the banking system. An ARC acquires bad loans from banks and financial institutions, usually at a discount, and works to recover them through a variety of measures, including sale of assets or a turnaround steered by professional management. Relieved of their NPA burden, the banks can focus on their core activity of lending. Long-term measures include improving credit risk management. This includes credit appraisal, credit monitoring, and efficient system of fixing accountability and analyzing trends in group leverage to which the borrowing firm belongs to. Structure of equity capital. Banks need to see that promoters' contribution is funded through equity and not debt. Banks should conduct necessary sensitivity analysis and contingency planning while appraising the projects, and it should build adequate safeguards against such external factors. Strengthen credit monitoring. Develop an early warning mechanism, and comprehensive MIS can play an important role in it. Enforce accountability. Till now, lowering officials considered accountable even though loaning decisions are taken at higher level. Thus, sanctioned officials should also share the burden of responsibility. Address corporate governance issues in PSBs. This include explicit fit and proper criteria for appointment of top executives and instituting system of an open market-wide search for chairman. Now, what can further be done? Some of the following approaches can be adopted. First, setting up of bad banks. A bad bank handles the bad business of other banks, freeing them of the burden of resolving their bad loans themselves. Concept is divide a bank's asset into two categories, good and bad. By separating the two, a bank can avoid the contamination of good assets by the bad. It also alleviates the concerns of investors and help the bank focus on future lending by improving health and transparency. Second, term lengths. The terms of bank chairmans should align with the life of the loan in order to effect meaningful changes and to hold them accountable. Terms of chairperson should align with the life of the loan, which would allow defaults to be detected and penalties to be meted out as required. More in-house expertise should be brought to evaluate projects. Bankers need a better understanding of the industries, and it is important that key permissions for projects are attained upfront. In cases where risk cannot be reduced, they should transparently be shared between promoters and financiers. Banks need to have the capacity to monitor projects so that those going off track can be restructured in time. Fourth, restructuring of incentives to ensure bankers are motivated to evaluate and monitor. Fifth, Raghuram Rajan has noted that Mudra loans and Kisan credit cards should be examined more closely for potential risk, as targeted credit often affects due to diligence on the part of the bankers. Thank you all.